This episode of the Old Dogs REI Network is brought to you by Mino Studio. Welcome to the Old Dogs REI Network, where cash flow is king. Real estate investing, the means, so you can enjoy your retirement dreams. This is the show where we cut right to the chase. No sales pitch, no long monologues, just simple how-to real estate investing advice, so you can earn the passive income you need to enjoy your retirement today. And now, your host and chief old dog, Bill Manassero.
Hello, old dogs, and welcome to
Fun Facts Friday.
This is our once-a-week, only on Friday show, where we have special episodes not featuring guests, where I will share tricks, tips, terminology, and techniques that will help skyrocket you to real estate investing success. Today's topic is, what is a good ROI for your rental property? Well, before we get started, again, I just wanted to welcome you guys to today's show. We want to thank you for listening, and we just really appreciate it. I know I don't say that enough. You know, sometimes we just get caught up in the day-to-day stuff, and we forget about the important things, and that is things like saying thank you. And so thanks for listening. And hey, if you like the show, we would love if you would go to iTunes and give us a 5-star rating and review. That just helps us to get the word out to more folks out there that are interested in looking at real estate as a means to help them in their retirement. So just really appreciate that. If you can, we'd love to see it. You know, I'm going to even start reading some of these reviews online. Let's go into our topic. What is a good ROI for your rental property? Being aware of the potential financial returns of an investment property is the driving force behind a purchase. How can you find out the financial return of a rental property? Through its ROI, of course. But what exactly is ROI, and what is a good ROI for a rental property? And how is ROI calculated? I'll address these questions in today's Fun Fact Friday podcast. But first, I want to let you know that ROI is just one of many different ways of assessing the value of a property. And I would recommend that you look at different factors, things like cap rate and IRR, internal rate of return, and even cash on cash, which I don't put a lot of weight in. But I think being familiar with the various ways of assessing a property value is important because you are an investor, and an investor needs to know what kind of returns you're going to get. So first, what does ROI mean? ROI is short for return on investment. It's the standard metric used to evaluate the returns on many investments. This standard is very comprehensive. It takes many important variables into account, including annual rental income, property price, and the expenses of the real estate property. When these variables are put together in an equation, ROI looks like this. ROI equals annual rental income minus expenses and costs, divided by the property price. And I'll talk a little bit about what each of these variables mean. Like annual rental income, that's pretty obvious. This is exactly what it sounds like. The annual rental income is simply the gross rental income an investment property generates in a year's period, So that's the 12 months of income in that property. It's calculated by multiplying the monthly rental income by 12 or by multiplying the weekly rental income by 52. Then there's expenses and costs. Every rental property comes with different expenses and costs. Some are reoccurring and others aren't. ROI takes all expenses and costs, whether they are property taxes or the costs of new furniture, repairs, maintenance, trash service, lawn cutting, whatever it is, and we put all those into account as part of the expenses and costs. And then finally, the cost of property. To truly understand how well a property is doing, its profit or rental income must be compared to its price. Okay, this tells you what the return is, right? The return on paying what you did for that property. Without doing this, a real estate investor may be deceived into thinking a rental property is performing well, even if it generates high income. But if this income is compared to its price or fair market value and it is insignificant, the investment property is actually not performing as believed. So what is a good ROI for a rental property? Well, you have to look at the question, what is a good rate of return on any investment? This is a subjective question. For example, a person earning 0.75% in a bank savings account may think a return on investment of 2% sounds great. And of course, the banks love to tout the great return of special savings accounts or CDs that are yielding a high 1 or 2% return, because their basis of comparison is themselves. They're comparing it to the other crummy rate that they have in their other accounts. But is it really a good rate of return? This certainly can be a topic of debate. Really, only you can determine what is a good return for you. But there are ways that we can look at this still subjectively, but in a way that might give you better comparisons. Now that you know sort of how to calculate ROI for a rental property, the next question must be asked, how do I know what is a good ROI for a rental property? The answer is pretty straightforward, but for clarity, we'll illustrate it with the ROI calculation example. Let's say you own a pretty successful rental property. It is occupied for most or all of the year. It's attracting great tenants and its maintenance functions are smooth. It also has a high monthly rental income of $3,775 a month. The property's fair market value is $275,000. This all sounds great, but is the property really providing a good return on investment? To find out, we'll need to calculate its ROI. Since the monthly rental income is $3,775, the property's annual rental income is $45,300. Okay, and that's per year, right? Its annual expenses, which include taxes, repairs, insurance, renovations, and more, they add up to about $2,000 a month. So what's the ROI for this rental property? To calculate the ROI, you take the annual income of $45,300, okay, minus expenses of $2,000. So that brings that to $43,300. Now you divide the $43,300 by the property price of $275,000. And what you get is 0.157 or 15.7%. Okay, that's your return on investment. So hearkening back to the original question, what is a good ROI for rental property? Again, the term good, as used in this question, is relative or subjective. Most people's second question would be good as compared to what? Like I used in the previous example. In the banking world, a 1% return is good compared to what you normally would receive. So if you're an investor, though, you want to look at ROI as it compares to other investments out there that you could potentially put the same funds into, right? For example, what's the average return of stocks, bonds, index funds, mutual funds, annuities, and so forth? And don't forget Bitcoin, right? Obviously, there's another factor here that we have to consider when trying to assess what is good. As you seek out comparable investments, you can't ignore the risk aspect, right? Okay, investing in treasury bonds or index funds can't really be compared to investing in Bitcoin. The risk is way too high for Bitcoin to compare it to those. That's part of how you have to look at this. That's why you need to look at rental property as what it is. It is a tangible asset, something you can see, feel, touch, and own. And it has a historically proven value. Unlike stock that can totally lose its value and be worth nothing, real estate is always going to be worth something. And historically, that something is always going to go up over time. But to best identify what is a good real estate investment, it's best to compare with other real estate investments, right? To see what other similar real estate investments are yielding. Sure, you can say, well, my Vanguard index funds, which are fairly low risk, have been yielding 8% for the last 3 years. And compared that to the 15.7% yield on my rental property, wow, that 15.7 sounds pretty good. And that's a viable comparison. But if you want to look at similar rental properties and what they're yielding, that might even be even a better comparison. But it might be difficult to get that kind of information from other investors who might not openly share that. So given our examples here, 15.7% ROI for a rental property is considered good. Great. We now know what is a good ROI for rental property. One more issue, however, has to be addressed. How does ROI change depending on the method of financing? Now, the example I used was a cash purchase. What is a good ROI for rental property if that method changes, if you decide to finance with a mortgage? There are different ways to calculate ROI for rental properties when you look at how you are financing a purchase. There are two main methods of financing a property, right? Purchasing it with cash, like our example, or through a mortgage. As a result, ROI calculations can differ as well. Let's look at purchasing your property with cash. If you can somehow purchase a rental property entirely in cash, then calculating ROI is not too difficult. All you need to do is use the ROI formula as we used in the previous example, right? ROI equals the gross rental income minus expenses and costs, okay, and that divided by the property price, right? So that's pretty easy. So taking our example, what is the ROI for a rental property when paying fully in cash? The answer still remains to be 15.7%. Let me try 7%. Okay. So, taking our example, what is the ROI for a rental property when paying fully in cash? The answer still remains 15.7%. But let's look at using a mortgage. If you, like the vast majority of real estate investors, decide to invest with a mortgage, calculating ROI has a slight tweak. The result is what's called the out-of-pocket method, or what is commonly called cash-on-cash return. In this ROI calculation, out-of-pocket ROI, or cash-on-cash, equals annual cash flow divided by the total cash invested. So on the surface, it may seem that this form of ROI equation is very different from the other one used for cash purchase. The reality is, however, that these calculations are almost the same or very similar. In fact, the out-of-pocket ROI contains a broader definition that could be applied to cash purchases. This formula uses annual cash flow instead of the difference between gross annual rental income and expenses and costs. Why? Because annual cash flow is merely an extension of the difference as it takes mortgage payments into account. Okay, so it includes all the other expenses plus the mortgage payment in there. The other change in the out-of-pocket or cash-on-cash calculation is using total cash invested instead of property price. That's because the real estate investor has not fully paid down the property when using a mortgage. Instead, when an investment property is fully paid for in cash, the total amount invested is simply its property price. Since the total cash invested tends to be much less than the property price, okay, the overall ROI is lower. An example will make this easier to understand. Let's use our previous example. To calculate our rental property's annual cash flow, take the difference between the annual rental income of $45,300 minus annual expenses of $2,000 per month or $24,000 for the year, minus a monthly mortgage payment of $1,111 or $13,332 annually. That equals an annual cash flow of $7,968. Okay, of course that's a lot less than if you didn't have the mortgage in there, and the property price is $275,000. So if the property is fully purchased in cash, as we mentioned, we had that higher cash flow amount of $43,300 divided by 275 gives you 0.157 or 15.7%. 15.7%. If the property is purchased with a mortgage and a 25% down or $55,000 down plus $9,625 in closing costs, okay, it's going to be a little bit different, okay? So to get the out-of-pocket ROI or cash-on-cash return, you take the annual cash flow of $7,965, divide it by the total cash invested of $64,625. Remember, that's the $55,000 plus the closing costs, okay? Or the $55,000 down plus the closing costs. And that equals 0.123 or 12.3% ROI. So it's still a strong return, okay? And purchasing investment properties with a mortgage still generates a significant ROI. So 12.3 compared to 15.7. But look at this, okay? The advantage is you can take that same $275,000 you were going to purchase one home with, and you can buy 4 homes valued at $275,000. Okay, and that's because you've got that $64,625, which includes your down payment plus your closing costs. You can get 4 of those out of that $275,000. Okay, you're going to still yield a great return on your investment, but you're going to have more properties that will generate more equity, that will also give you the tax advantages that you will have from the mortgage interest and the depreciation expenses and so forth. So you've got a much broader real estate portfolio. You've got 4 properties as opposed to 1 that, yeah, it'll yield a stronger cash flow. But the idea is, as you grow these properties and you acquire more, is that you pay them down more and more so that you have more and more equity each time. And over a period of time, you eventually own them outright anyway, right? So, but the leverage is good. The leverage can help you to get properties at a good price in good markets and to be able to grow from there. So even though a property is fully paid for when purchasing with cash, it can take longer really to get any kind of a return on it. And you certainly aren't going to have that compounded effect that you have by using a mortgage as leverage. Knowing what a good ROI is for a rental property is important for real estate investors. There are few investments out there that can match the returns of rental real estate. Well, that is it for today, guys. I just want to let you know everything I mentioned here is in our show notes, so you can get that information and look at it there. I'm also going to add some links in there because I do reference things like cash on cash. I talked about IRR and just briefly and cap rates. We have some other episodes, our Fun Fact Fridays, where we've talked about those topics a lot more in detail that you can get more information on as well. Well, that's it. So until next time, remember, cash flow is king and real estate investing the means. Thanks again for listening, and may God bless.
Thank you very much for visiting the Old Dogs REI Network. We would greatly appreciate if you would stop by iTunes and let us know what you think of the show. We would love if you could subscribe to the podcast, give us a 5-star rating, and write a review. The more ratings and reviews we receive, the more visible the podcast will be to others. Thank you.